you don't want to buy high.
No.
You want to buy low
And sell high.
and sell high.
That's right.
Now, so diversification comes in where you know which one, when we're in trouble, when you're in trouble for whatever reason, you know which one to touch, because then that one is fine. It's okay. The risk is low.
Invest where you are at that moment,
100%,
right?
100%.
Everyone talks about all these different vehicles that are available, which is incredible.
In investments, often, whenever you get lower returns, it means that the level of risk is also lower. Whenever you're going to get high returns, it means that the level of risk is also equally higher. And so it's nice to have a blend when you need a blend.
Hey, Red Circle family. Welcome back to Brick by Brick, your property power purpose podcast right here on Red Circle Television. I'm your host, Dudu, and this is our money mindset and property series, and we're continuing on with it, okay? So on this episode, we are going to be discussing probably one of the most interesting topics, because I think people maybe understand it differently as well, depending on where you are in your investment journey. On this specific episode, we are going to be looking at diversification. So we're unpacking the importance of diversifying your portfolio and looking at different asset classes where you can continue to invest, but obviously not having all of your eggs in one basket. And of course, I am joined by my personal wealth advisor, Palisa from Imvelo Wealth. Thank you, Palisa, for joining us again for this series.
Thank you for inviting me once again, Dudu.
And welcome back. Welcome back.
Thank you. Thank you. Looking forward to it.
Yeah. So this episode, diversification, I think sometimes people understand it in different ways. And it's not always very clear in terms of when you say diversification, what do you actually mean, right? Does it mean I take this money and I put in a bank, and then this one I put it maybe in something else? Or are we looking at specific investment vehicles where we can then say, I am now diversifying my investments?
Well,
right? I have my own ideas of diversification, and I think maybe you can help me to also correct and also understand what they mean. Okay. So tell us a little bit. What is diversification? Maybe let's start there.
Okay.
Let's dissect it a little bit.
Okay. All right. First of all, I just want to say that I'm excited. I'm really excited about this topic. It's something that is quite close to my heart.
Oh, amazing.
So when it comes to diversification, I mean, I'm not going to bring in the Oxford Dictionary explanation of what diversification is, but rather really just to make it a bit more practical, to say when you are diversifying, and the oldest way of putting it, or the one of the most common ways of knowing diversification or understanding diversification, is that whole saying that says, don't put all your eggs in one basket.
Yeah.
That's it. Don't put all your eggs in one basket.
Yeah.
Put one here, one there, because you never know which one will hatch first and which one will end up maybe going rotten, or whatever the case may be. So really, it's about that. It's about risk management. That's the long and the short of it. The thing is, when it comes to investing, we never know for sure exactly what will happen. We know what is available in the universe, but we never know for sure that this will happen before this. Then, of course, there's this whole concept of risk, where we don't know what could potentially go wrong while we're on a nice journey to, let's say, achieving our goals. And so that's why we need to have those, call them risk management place where you just constantly, and ears and eyes, where you're constantly looking at different directions. You know, a positive thing might happen here, but a negative thing might happen there. And so you need to be constantly searching the environment and constantly be aware of what's happening. And yet at the same time, it's not easy to act fast. Even if you become aware, it's not easy to act fast. And so diversification comes in to say, if this doesn't go well, then that will protect you.
Right.
Yeah.
And why is that then important in our economy specifically? Let's speak now to the South African economy and why it's important for us to consider diversifying.
Okay. So very, very important. Look, I think it doesn't matter whether you're living in the US, you're living in South Africa, anywhere in the world. We live in a global world. But again, then to take it back to your question, if we look at South Africa specifically, there's lots of market downturns that we've experienced over the years. There's been lots of opportunities that we've also experienced over the years. And when you just combine those together, then you realize that you can never know for sure. There is no straight line. There is no, this is definitely the outcome that we will get out of this. So with South Africa specifically, we live in a diverse world. There's lots of political uncertainties that have taken place. There have been lots of political uncertainties right from when I started going to school back in the early 90s and in the late 80s. There were already issues right then, and a lot has happened. And a lot has changed since then. And so it's important to always brace yourself because you never know what will happen. We've got a lot of influences from abroad.
That's right.
So for the very same reason that we have gone through a lot as a country. So there's been a lot of influences that have come onto our country. And those influences affect our economic outlook, or just in general our economics as a country. And so with that, then you always need to understand that things will never go in a straight line because of all those things. But as I said earlier, we live in a global world. So influences are not only coming from within the country, they're also coming from externally. And with that, then you need to always be sure that you've got your guardrails all around if you can, yet at the same time. And that is such a difficult thing. To have your guardrails while at the same time you open yourself up for opportunities. Can you imagine how difficult that can be? And so diversification then as a concept really just says that you cannot then just be putting all, let's say we here now, we know that property is going to be doing well over the next 5 years, which is a very long time, by the way, in the investment horizon, because things can change within a matter of a day, a matter of a week, a matter of a month, things can change. But let's say you hear that things are going to go well for property over the next 5 years. Sadly, things don't remain like that. Something might happen along the way. So with investments, you can find that property currently is giving what? 30% return as an example. So interest, to put it simply, interest rate that you could be generating from that on an annual basis. And something sudden happens. And let's take COVID, which is a classic example. I was going to
use that as an example. I think everyone can relate to that.
Classic example of what happens.
The most recent.
The most recent is still very fresh in our heads. Then something like COVID happens. And again, and with these things, you can't say COVID will not happen again. Yes, it won't be COVID, but there was 2008 that happened. There's always something that happens, and markets go in cycles. They don't just remain static. They go in cycles. So back to COVID happens. What happens what happened when we look at 2020, for instance? What happened in that year is we were cruising nicely with your 15, 20, 30%, whatever returns you were getting.
So nice.
And this thing happened within a matter of days. Boom. Everything dropped. No one expected it. And property, for instance, it weren't as bad as I remember at some point I was looking at one of the portfolios I was looking after, and it was doing minus 40. Even when you were looking at the property index itself, it was somewhere there.
Yeah.
But at the same time, had you left at that time, had you not have your eggs in other baskets, because if you didn't have any other money and all your investments were in property, and you needed now to supplement your life.
Sure.
In other words, you needed to now buy groceries, and you needed to pay for things that you need to pay for medical aid and other things that you need to pay for to continue to survive. Then you would have been in trouble, because you would have had to take that money on minus 40 as an example.
Oh, wow.
What does that mean? It means that you bought high and you're selling low. You're selling for less than what you bought it for. It's a loss. It's a permanent loss. Because if you take your money out, or you sell that property, or you sell that property share that you have, or you had, then it means that you are now getting rid of, or rather, you're taking a permanent loss. You've lost that money.
Right.
But if you had your investments in other types, or you had invested in other types of assets that were not affected as such, and we'll make an example. Let's say you had a money market account with a bank, for instance, or even a unit trust as an example, which is a different asset class. Then you would, at least, because with certain types of investments, they don't grow that fast, but at the same time, they won't then get affected as severely as the ones that are performing so well.
Right.
And so you would have still said, okay, at least I've got some money in my bank account. I can still be able to withdraw that money or in my money market investment, then I'll still be able to pay for certain things.
Right.
And that's where diversification comes in, because then if you did not have that, you would have had to take that permanent loss. But now, because you had something that could supplement you, you then decide, I'm not going to take this permanent loss because I've got this. I'm just going to leave it there until it recovers. Guess what? A few months later, property recovered.
Things change, yes.
Things change.
Those are the markets.
And if you're not
Markets
there,
move up and down.
they move up. If you're not there, if you had not diversified so that you've got other alternatives, when that happens, then you don't get to participate, so you miss out on the opportunity.
That's right.
And then you don't make money.
Right.
You don't get to grow your investments.
It's so important to always think ahead, I think. And as you're saying, the markets are unpredictable. We are interconnected as the globalization has allowed for us to be interconnected. Our markets are interconnected. So whatever happens in America can affect us. Right? COVID happened, it affected everybody. And unfortunately, I don't think our economy was in a position to carry that crisis through, as opposed to perhaps other economies. And I think we then began to experience a lot of that downturn in the economy. And if you were not prepared for that, sure. And I think a lot of people lost a lot during that time. Unfortunately, a lot. And had you perhaps had that portfolio that was, diversified, then you would have been able, as you're saying, go into different asset classes and be able to continue to survive from that. So let's perhaps unpack some of the different asset classes.
Okay.
I love property, obviously. Property works for me. And yes, it can be a risk. It can be a massive risk. And it's why you always have to be prepared for any eventuality when it comes to property. And sometimes it's long-term, that type of investment. You're not going to see immediate returns from it. And sometimes you can sort of set it up in such a way where you begin earning something, in a much shorter term or time frame. I love property, but property isn't the only investment class that I invest in, right? I have a number of other ones. Perhaps you can take us through some of the other ones that, our audience can consider. And I'll tell you some of my new favorite ones that I want to run by you as well.
Okay, that's good to hear.
Yeah.
Good to
So let's unpack some of the different ones, some of the different vehicles that they should be considering.
All right. Look, I also love property like you. I think it's definitely an asset class that one should have in their portfolios. But as you rightfully said, it's not the only solution, or rather only asset class that one should consider when they are busy building portfolios. I like the concept of building blocks when it comes to building a portfolio.
Okay.
Building blocks in that it's important to not want to try and do everything at a go.
One go.
At one go, right? And also because we are at different as phases of our lives at any given point, what you are able to do today, maybe I'm not able to do today,
Absolutely.
So it's important to understand. And so one of the things that I use when it comes to investing and you look at different asset classes is I use the analogy of Maslow's hierarchy of needs, where not everything will be taken care of at the same time. It depends on the level of risk that you are looking at, as well as the space you are in your life. So I'm going to try and put in that. Also, there's different phases that we go through in life as we grow older. We go through a phase where we're building. We go through a phase where we start to having, we start working, we start having kids, we start getting married, and then ultimately we get to retirement. So even if you look at it from that point of view, it means that you can't do everything. At one go. So when you look at the whole concept of the Maslow's hierarchy of needs, right at the basic level of it is you need shelter. You need a roof over your head, right? And so that's one of the things right there at the bottom of it. And so at that point, perhaps what's important to incorporate in your asset classes, in your process of diversification is, obviously you may think, I want to rent a property or I'm going to buy a property. It's important obviously to analyze and check, are you at a position to do that? But even before you do that, a different asset class in that instance is to have cash. You need to have cash. If you're going to be investing in property, you need to have cash at your bank. Cash for what? At that point, the type of cash that's important is an emergency fund. It's what we call a reserve. An emergency fund is also one of the common terms that we use. Have an emergency fund. You could have put that money at a bank or in a unit trust or something to that effect, but have those cash reserves. That cash is a different asset class, believe it or not, to, for instance, property. It's an asset class on its own. It's got its advantages, it's got its disadvantages. The main thing, what's important when you're looking at that is that you shouldn't be looking at very high returns because you need to make sure that you protect. So at that point, the important thing is you need to have something that you can run to that is easily accessible, that you can use as and when you need to without having to pay penalties,
right?
Or wait for 30 days. Because for me, I always say 30 days is not an emergency. If I take a 30 days in bank, what do you call those bank deposit?
Yes.
That's not an emergency account in my view, because I'm not going to wait 30 days and then I get penalized for it if I then want to break that 30 days.
Yes.
So I'm saying, so that's one of them that you can have right at the basic level. So that's your start, right? You build that nicely in your first phase of your career while you're still building up, right? Hopefully at that point you don't even have kids. But if you have, then hopefully you're able to manage things, right? So it's at a basic level. Then as you're building up, then you say the next level is, I'm going to buy myself now this property in 5 years' time. I'm buying my 2-bedroom or whatever. 3 years' time, 5 years' time. Abilities are different for different people.
That's right.
Also, it depends on what you want to buy. But the other types of investments that you can add in terms of your portfolio at that point is if you've got kids, for instance, or if you are planning on buying this property or something like that, there's a type of investment called an endowment, as an example. You can start investing into an endowment, you can start investing into unit trusts, and you can start, but on a more long-term basis, and not like the one that I spoke about now, which was for like a 12-month period or something like that. Well, let's call it 12 to 24 months. Now, That's another type. So that type introduces you to more asset classes now. So an endowment, for instance, will introduce you to, for instance, shares, because within an endowment, the underlying funds could be shares as an example.
Right.
It could be exchange traded funds as an example. So there's different types that exposes you. So what you're doing just in those two levels that I spoke about, the first one being the one at the basic level, the safety one,
Yes.
the roof over your head one,
Yes.
and the next one being, I can't remember now, of the Maslow's hierarchy of needs, the second one, but that second level, when you just think of those, you would have been exposed to about 5 different asset classes already by that point. The cash one. You've got shares that you're already exposed to.
Right.
You've got exchange traded funds that you're already exposed to there. You've got you may have property that you're already exposed to. So there's you already started to diversify. To diversify.
Right.
Then right as you get to the top of your hierarchy, there's other types of asset classes that you could be considering. Now you are at a point where you've taken care of your basics. You've taken care of your goals. Your goals, what I didn't talk about is there's even retirement annuities, which are also exposed to similar asset classes. But right at the top, then you may be thinking, I actually also want to invest in other people's businesses.
Right.
That's another type of asset class that you can consider. So you've been exposed to all these, but at the same time you feel, I want to now use my money so that it can assist other people, grow other people's businesses as well. I didn't even talk about cows. But again,
I was going to get to that one. Kettle. Yeah. Everyone's talking about that now.
Before I close, everyone is talking about it. I was actually listening to it this morning. But look, the important thing is be open, but at the same time understand the level that you are in, or rather the phase that you are in your life.
100%.
Start by covering your basics first. Understand that it's important to have all your things in different places and not all your cash at the bank. And at the same time, then be open to just trying new things. The important thing also that I am going to forget, and I don't want to forget, is the risk associated with all of them. I'm putting them in levels, not only just in terms of the returns that you're going to get out of them, but also in terms of risk that comes with it. In investments, often, whenever you get lower returns, it means that the level of risk is also lower. Whenever you're going to get high returns, it means that the level of risk is also equally higher. And so it's nice to have a blend when you need a blend. So if you go back to the concept of Maslow's hierarchy of needs, you can afford to take as much risk as you want if you've taken care of all your basics. And when you're now able to take risk, then you know that you are taking risk because you're going to be rewarded for the high level of risk that you're taking. That's not your everyday money. That's not your spending money.
No.
It's your wealth building.
Generating money.
Generating money. It's not where you're saying, I want to preserve and I want to protect my money. It's where you're saying, I want to invest my money in such a way that it can generate as much returns. And if markets do fall, I don't have to rely on it. I will leave it until it recovers again.
Yeah, it will just keep moving with the market.
It will just keep moving with the market.
Ignore it. Yeah.
I've said a lot of things. And I'm really hoping that
they
will make sense.
They make sense.
Yeah, I'm hoping that you can make sense for them.
No, it absolutely makes sense. I think the most important aspect to what you're saying is readiness.
Yeah.
Invest where you are at that moment.
100%.
Right?
100%.
Everyone talks about all these different vehicles that are available, which is incredible. You touched on the kettle just now, the cows, which is a very popular one at the moment. There's art, for instance. That's one of the ones that I'm very interested in as well. So I'm wanting to introduce myself to investing in art more and more. But of course, I still need to understand that asset class as well. You know, how does it work? You know, what do I actually buy? And how over, you know, whatever period of time is it going to benefit me as well? So start where you are.
Mm-hmm.
That is the most critical.
Yeah.
Because otherwise, you'll end up in a crisis.
Start where you are, but also understand the level of risk
that you're willing to
that
take.
you are willing to take and the longevity that you need to have as an appetite when it comes to that investment vehicle. Because, for instance, art, I would imagine, I've never invested in art.
Me neither,
but I would imagine that it should be a long-term investment.
That's
and
right.
Not rather, where you're just buying and selling at any, because you could be selling it when it's actually about to
It's
be
no
popular
longer,
and take,
Yeah.
and generate way more returns than you would if you're selling it when you're desperate. The
right.
thing to avoid is to sell because when do you make money when it comes to investing? When you sell.
When you sell, of course.
That's when you make money.
Yes.
So now you want to buy low. You don't want to buy high.
No.
You want to buy low
and sell high.
And sell high.
That's right.
Now, so diversification comes in where you know which one when we in trouble, for whatever reason, you know which one to touch, because then that one is fine. It's okay. The risk is low. It's low enough. It was intended for short term.
That's right.
It was not intended for long term. And so you can touch it. But the other one, you don't touch it unless you really, really, really must. So the other thing with diversification that I don't want to forget is we often just focus on its different asset classes, but also you can also diversify. This term is turning to be very difficult
it's
for
the
me.
Episode diversification. Yes.
So you can diversify. You can diversify in terms of asset classes, but also in terms of regions. You spoke about local and offshore, so you can also diversify in terms of regions as well. You can diversify also just in terms of the types of, how do I put it? The types of goals, let's call it that, the types of goals. So you could be diversifying, because sometimes we also think of things in a linear way from, if I've got just one investment account, that's okay. No, you need to have a different account for different goals. That's also diversification. So diversify in terms of having a retirement annuity for retirement, having an investment, an education plan for education, have, I want to think of other ones now. Otherwise I'll only be limiting you to the ones that I'm always talking about. I want to talk about, have savings specifically for education. For traveling, for
buying property,
yes.
What else? For just your simple expenses, 100%, as you were saying, 100%. The ones that you can go into without any major risk there,
100%. Have the bank one as well. Still have your bank product as well, but don't put all your money in that one basket investment, which is just that bank. Also, don't put all of it in your property, which is just again one investment, or in an endowment, which is just one investment, or within a unit trust, which is just one investment. Just diversify in terms of your different goals.
Spread it out.
Write your goals down and say, I want to achieve this by then. And then you tap onto a professional to say, okay, which type of vehicle can I use for this particular goal? And you'll find that it's always different ones. So for instance, I want to bring in the kettles. In the homelands, in my village, for instance, one of the things that they do is, especially in my village, there's always imigidi.
Yes.
Every December. And so there's also stokvels that people use. Yeah. That's another asset class.
Absolutely.
If you think about it, it's another way of diversifying your investments.
Absolutely.
You've got a stokvel that you're going to use for lamgidi, so that you've got money to get groceries, or they buy groceries in bulk and then they bring for you. And then Tata at home, they will have kettles and they will sell each other kettles during imicimbi, so that they don't have to go and buy them expensive, at the farm, in town, at the farms and all of that.
Yes.
So that's another way. So the kettles, even in their physical being, it's a form of investment, but it can not be the only investment that you have.
That's right.
Yeah.
That's right. No, very important To diversify. Yeah. Absolutely. I think this was one of the conversations that we had when we first started discussing my portfolio. And I think the most important question you asked me was, where do you see yourself after retirement? What kind of lifestyle do you want to live? You know, where are you living? What car are you driving? What are your kids doing, etc., and how are you supporting them, and so on and so on. And when you begin building onto those building blocks, as you mentioned, I think the goal becomes the key in that. And I told you, smart, honestly, I just want to be, you know, well taken care of, retiree. You know, driving my fancy car, still taking care of myself, still looking, you know, put together. And in order for me to be able to continue to live at that level, let's say, I need to prepare. Right? I need to prepare. And the conversation got to, where do we start? What makes sense for you right now? Where you are with what you have, and also what I'm interested in, right? So property was one of them. And then we also had all the other asset classes that we started putting together as well, that we have together now. The emergency fund was also one that we implemented, and it worked wonders for me. And I still need to go back and put some more in there, you know, worked wonders. And it worked exactly how it was supposed to work, I believe. 100%. Had it not been there, like I mentioned in our previous episode, I would have probably been in a bind, a serious bind at that stage. So having that discussion is critical, and ironing out what your goals are, where you want to see yourself in the future, and which asset classes should you then begin to consider on that journey.
100%.
I love it.
100%.
Art? Yes, no, maybe so.
Yes. When you get to self-actualization. And I can't say now whether you're there or not. We're
still moving. Yeah, we're still headed in that direction. But yes, and I think I need to be able to study it very well and understand, why do they buy, how do they buy, who are they buying art from, and how are they analyzing the returns on that art.
When do you sell it?
When do you sell?
How do you sell it?
Exactly.
So that you don't sell it low.
Exactly. Yeah. No, that one's going to be a tricky one, but I'm really interested in that one. But yes, so property, absolutely one of the vehicles that I think works really well. Then there's stocks. I recently had a conversation, not recently, I think it was a few months back. We had a conversation about stocks. So I began having interest in investing in stocks as well. Very different. Very challenging as well. And different. Analyzing that stock market and all the different stocks that are available, also very challenging. But I'm interested in learning. And I want to be able to put my money in places where, you know, I think they could do very well while I'm learning, but obviously not taking a high risk. So I don't go in with like 50,000 or 20,000. Little by little. Then we study it, and then we see where it's headed and where it's going.
And I think one day you will have an expert in that space, and you can have that conversation. So I think it would be a great conversation for your listeners to listen to, to hear, because I think often it's one of the ones that I think it's misplaced. A lot of people would just want, right, as they start on and they hear so-and-so is investing in, the other term for it is shares, as I was mentioning earlier. So-and-so is you know, buying shares or
Coca-Cola
you know, those things that people do, forex or whatever the case may
forex
be.
Traders
and
so
there's
on.
nothing wrong with those, but again, it's important to understand when and how best to do it.
It's very complicated.
It's not as easy as it looks. So I'd encourage you to bring a professional when it comes to that.
I think I will 100%, because I think on social media we're sold a very different story.
100%,
right?
100%.
We're made to believe that, you know, once you start buying stocks or once you start trading forex, you're going to be driving that Ferrari almost instantly, etc. But the risk is enormous.
The risk is enormous. What is strange, though, is what you will notice that there's risk, because then the people that are encouraging you to go and trade are actually spending more of their time teaching you how to trade and making more money by teaching than actually trading. And you ask yourself, why are you not trading yourself?
Right.
It's so lucrative and so easy.
Yeah.
And so it's important really to, as a type of an asset class, or rather as an asset class, it's important to fully understand it, but also understand it doesn't come at any given point in your building blocks. It's got its space, and you need to try and do it at the time that you are ready for, because it's got its own risks that are inherent, that are potentially also very high as well.
Yes.
So, yeah.
So research, mentorship. Don't just jump into things because they're popular or they're trending.
100%.
Yeah.
100%.
And it's the same almost with anything, I think. You know, take your time and really educate yourself on all of the different asset classes that exist, and speak to the experts, and you'll find yourself in a much better position.
And one last one for me is to add is that with property specifically, understand that you may have a physical building as a property, but you also have stocks that are only focusing on property.
Yes.
And ensuring that you've got a professional helps you in avoiding to be overexposed to one asset class, because if you've got it in your portfolio and you've got it as an investment vehicle, physical investment vehicle, you may be overexposed, which again then will take away that whole goal that you get when you diversify.
Yeah. And I think also the other thing is to have our audience understand that you can start at any point in time. Start where you are. Even if you have limited capital, you can still diversify, as you explained. And just have it as an option always, because this world is unpredictable. Now we're dealing with wars that are also affecting our markets and also affecting economies. And if you're not prepared for some of these political maneuverings that are happening globally, right? Then you are going to find yourself potentially in a position where, some are moving and then you're not, unfortunately. So diversification, absolutely key. Absolutely key. Well, thank you so much, Balisa. I love diversifying. And although I speak a lot about property on this podcast, I really want the audience to understand that there's so many other investment vehicles that they can use. And of course, they can get in touch with Imvelo Wealth, and I'm sure you'll be able to take them through and give them those options
100%.
and cater, their portfolios to their needs, essentially. Yeah. Well, thank you.
Thank you for having me.
There you have it, guys. So diversification, absolutely key. And don't put all your eggs in one basket. That is a very true saying, a very common saying, but it is absolutely true, because you never know where the world is headed, what the economy or the markets are going to be doing. And for as long as you know that you have options, then you know that you're in a much better position than most individuals. So thank you for joining us for this series. And we are going to be seeing you in our next episode, which I think is going to be our last episode for this series. But you will come back. I know you will come back. You will have to come back. There's so much more that we can talk about. But we'll see you in the next episode, guys. Bye.